Now, it is time for the financial statement analysis that you have been waiting for. From an investor's perspective, Doximity's numbers are truly close to art. They show the most ideal metrics that a SaaS company can display. First, the gross margin is close to 90%. This means that if they sell $100 worth of product, $90 remains as profit. This is an unimaginable number in manufacturing and is in the top tier, even among software companies. It is the dignity of a pure platform business with almost no cost of goods sold. Second, the adjusted EBITDA margin is 55%. Usually, high-growth tech companies often grow while making losses, or have profit margins in the 10 to 20% range. But Doximity retains more than half of its revenue as cash-generating profit. In the U.S. stock market, there is something called the Rule of 40. It is a rule that says, if the sum of the revenue growth rate and the profit margin exceeds 40, it is an excellent SaaS company. Let's look at Doximity. Revenue growth rate of about 20% plus a profit margin of 55%. The sum is 75. It is an overwhelming efficiency that exceeds the benchmark of 40 by nearly double. Third, the net revenue retention, or NRR, is 123%. This metric shows how much more money existing customers spent a year later. If it is over 100%, it means customers did not leave and increased their spending. Doximity's top 20 customers spent 23% more money this year than last year. In other words, Doximity has a structure where it can generate more than 20% revenue growth every year, just by sitting still without sales reps chasing new customers. Cash flow goes without saying. Free cash flow exceeds $260 million annually, and they are running debt-free management with almost no debt. It is hard to find a tech stock with such a robust financial structure in this high-interest era. But everyone, we have to ask a cold question here. If 80% of U.S. doctors have already signed up, isn't there nowhere left to grow? Isn't the market saturated? Doximity management must have naturally worried about this too. So there are three major future growth drivers they have prepared. The first is AI, artificial intelligence. Doximity recently launched a service called Doximity GPT. It is based on ChatGPT, but is a doctor-specific AI made to comply with HIPAA, the medical data security regulation. There is a reason why this is a big deal. As I mentioned earlier, doctors are buried in paperwork. But if they use this AI, even if the doctor just roughly speaks or leaves a note about the consultation with the patient, it instantly writes a prior authorization request to submit to the insurance company, or a referral letter to send to another hospital in a perfect format. The reaction to this feature among doctors right now is explosive. Currently, they are offering it for free to strengthen user lock-in, but in the future, it has powerful monetization potential to be sold as a paid add-on to hospital systems or converted to a premium subscription model. The second growth driver is hiring solutions. The U.S. is a country with a chronic shortage of doctors. Hospitals are in a frenzy because they cannot find doctors, but competent doctors do not look at job sites. They are already earning well. They are passive candidates. But what app do they look at every day? It is Doximity. Hospital recruiters can use Doximity's talent finder feature to send job offer messages directly to potential candidates, whose intention to change jobs is not outwardly visible. It is similar to LinkedIn's recruitment model, but it is much more powerful because it is specialized for the medical field. The third is the expansion of the user base. They are actively embracing not only doctors, but also nurse practitioners or NPs and physician assistants or PAs, whose prescribing authority is expanding, since pharmaceutical companies are also increasing their marketing budgets for them. As well as doctors, this becomes a new revenue pipeline. Of course, there is not only a rosy outlook. There are risk factors that we as investors must check. The biggest risk is the macroeconomy and the volatility of pharmaceutical budgets. Doximity's revenue depends absolutely on pharmaceutical marketing spend. If the economy goes into recession, or if pressure to cut drug prices intensifies due to the Inflation Reduction Act, pharmaceutical companies may cut marketing budgets first to defend profitability. In fact, the slight slowdown in Doximity's growth rate in 2023 and 2024 was due to uncertainty in this macro environment. The second is regulatory risk. Healthcare data is handled more sensitively than financial data. What if patient information is leaked within the Doximity platform, or a controversy arises that pharmaceutical marketing has infringed on the privacy of doctors or patients? This is not just a matter of paying a fine. it becomes a fatal threat that can shake the very existence of this platform, where the trust of doctors is a core asset. Finally, there is the intensification of competition. There is no all-in-one platform as perfect as Doximity yet, but LinkedIn or other health tech companies will not sit idly by watching the high margins of this market. We also need to watch how they defend against competitors trying to enter the niche. Now let's summarize the long story. Doximity is not just a social network. It is a platform company that revolutionized the backward U.S. medical communication market, dominated by faxes and pagers with mobile technology. The reasons I rate this company highly can be summarized in 3 points. First, it has a powerful network effect and moat that competitors cannot replicate in a short time, holding tight to 80% of U.S. doctors. Second, it has proven cash-generating ability in the top tier of the software industry, with a gross margin of 90% and an EBITDA margin of 55%. Third, it is seeking qualitative growth by expanding its business area beyond a simple billboard to work automation through AI, the recruitment market, and telemedicine infrastructure. Of course, we must always keep in mind the dependence on pharmaceutical budgets and regulatory risks. But until the day fax machines completely disappear from U.S. hospitals, and as long as the desire of pharmaceutical companies to sell drugs to doctors exists, the toll for this digital highway, built by Doximity, will continue to get more expensive. This concludes the in-depth analysis of Doximity I prepared for today. What are your thoughts on this hidden giant, moving the $4 trillion U.S. healthcare market? Can their growth continue? Please leave your various opinions and insights in the comments. I hope this video helped broaden your investment judgment and your view of the industry. Thank you for listening for such a long time. I will come back with a deeper and more interesting company analysis next time. Thank you.